Welcome to the Deep Dive. Today we're really getting into something major, the Nigeria Tax Act 2025.
Yeah, this is huge.
It really is. This isn't just a minor tweak. It's a massive reform set to change, well, pretty much everything about financial life for individuals and businesses in Nigeria. It kicks in for income earned from January 1st, 2026. So if you live in Nigeria, work there, maybe you invest there, or you're earning money online or from overseas, yeah, you really need to tune into this.
Absolutely. And what's really striking is the sheer scale of it and the stated goals. Nigeria's tax to GDP ratio has always been quite low, around 6, maybe 7% historically.
Way below average for the region, right?
Exactly. So the government is aiming for fairness, inclusion, and trust with this act, trying to swap that low collection rate for a unified, progressive system. So our plan today is to really break down these new rates, get clear on what actually counts as income now, because that's changed, and, walk you through the practical things you need to do to stay compliant without getting totally overwhelmed.
Sounds like a plan. We've got the sources laid out. So here's how we'll tackle it. First, the new income tax brackets, the progressive ones. What do they mean for the average person? Then we'll dive into how the tax net is getting wider, especially for digital stuff like YouTube, crypto.
Big one, that.
Huge. Then that zero tax break for small businesses, that's a positive spin, but also the tricky side, like presumptive tax.
Yeah, the informal sector challenge.
And finally, the big one for many, the 183-day rule, how it impacts Nigerians living abroad.
Right, let's start with personal income tax, PIT. That's what most people feel directly in their pockets. The main shift really is moving away from sometimes confusing levies and flat rates towards a proper progressive structure.
Meaning the more you earn, the higher percentage you pay, but only on the portion in that higher bracket.
Precisely. It's designed so lower earners face less burden, ideally none at the very bottom, while higher earners contribute, significantly more as their income goes up.
Okay, let's get into the specifics. The numbers themselves kind of tell the story. There are 6 tiers.
6 tiers, yes.
And the first one is key. Earning up to $800,000 a year
is completely tax-free. 0%. That's the floor.
That's a pretty significant floor. What about after that? Where do the rates kick in for, say, the middle class or higher earners?
Right. That 800,000 threshold is crucial, though. Like you said, we need to talk about inflation later. After that, the rates climb pretty quickly. From 800,000 up to 3 million, the rate is 15%.
Okay.
Then from 3 million up to 12 million, it's 18%.
Right.
12 million to 25 million, that bracket is taxed at 21%.
Getting higher.
Yep. 25 million up to 50 million, you're looking at 23%.
And the top tier.
Anything above 50 million per year, that income falls into the highest marginal rate, which is 25%.
Okay, so those are the marginal rates. The rate applied to the last NERO earned in that bracket. But maybe we should clarify how that calculation works. Because it's not like your entire income gets hit with that rate, is it?
Exactly. That's the crucial misunderstanding sometimes. It's progressive, calculated in slices or chunks. Let's use an example. Say someone earns 1.2 million a year.
Okay, so just above the tax-free limit.
Right. Their first 800,000, still zero tax, completely shielded.
Got it.
It's only the amount above that threshold, the 400,000 difference, that gets taxed at the 15% rate.
So 15% of euro 400,000, that's 60,000 per year.
Exactly. Which works out to just 5,000 a month in tax. So their effective tax rate on the whole euro 1.2 million is actually only 5%.
Ah, okay. That really shows the progressive part in action. Much lower overall rate for someone just over the threshold compared to the marginal rate.
Precisely. But for someone earning, say, 60 million, well, their income slices will fill up the lower brackets, and everything they earn above 50 million gets hit with that full 25%. Their overall effective rate will be much, much higher.
That clarifies the how much. But the next huge question is, what are people paying tax on? Because you mentioned the definition of income itself has broadened quite a bit.
It really has. This is probably one of the most modernizing parts of the act. We're moving beyond just thinking of income as your standard office salary slip.
So what's included now that maybe wasn't explicitly targeted before?
Well, things like freelance work, profits from your own business, any rent you collect, capital gains from selling assets, investment income, that's all explicitly in.
Standard enough, maybe?
Yeah.
But the big headline seems to be digital revenue.
That's the one catching eyes, definitely. We're talking YouTube channel monetization, those brand deals influencers get on Instagram or TikTok, earnings from online gig platforms like Upwork or Fiverr.
And crypto.
And crucially, yes, profits from trading cryptocurrencies. If you buy low, sell high, that profit is now clearly defined as taxable income.
Even things like maybe getting tips via PayPal if you're a streamer.
Potentially, yes. The principle is broadening, and it even extends to some employer benefits in kind. Things like the value of having a company car for personal use, or maybe a housing allowance. These could be assessed as part of your taxable income.
Wow. So the basic rule of thumb is
Pretty much. If it puts money in your pocket as a result of your work, your business activity, or your investments, whether it came from Nigeria or showed up from overseas, it's probably taxable income now.
that sounds straightforward as a principle, but practically speaking, how does the government actually track, say, a small crypto gain or a payment from an international client to a freelancer? Is it all down to what shows up in Nigerian bank accounts?
For now, yes, the main lever is the formal financial system. The Act really leans on linking everything back to your tax identification number, your TIN.
Which has to be linked to your bank accounts now, right?
Correct. Banks have a duty to verify TINs. So, while they might be developing more sophisticated digital tracking, the immediate tool is transparency within the banking system. If you cash out that crypto profit or bring that foreign freelance payment into Naira through your Nigerian bank, there's a record.
So even small creators, freelancers,
Yeah.
they need to track everything now.
Absolutely essential. Every transaction matters.
Okay, let's shift gears to the business side. Amidst all this widening of the net and talk of enforcement, there is actually some quite good news for smaller companies.
There is, and it's significant. It's a major incentive aimed squarely at micro and small businesses. If your company has an annual turnover that's total revenue coming in of 100 million or less,
Okay.
and its fixed assets like property and equipment aren't worth more than a 250 million, then you qualified for 0% company income tax.
0%. That's huge.
It is. It's basically saying, look, focus on growing your business first, get established, then worry about CIT. It's a potential lifeline, especially for startups and smaller operations.
What's the catch? There's always a catch.
Aha, well, the catch is proof. You need to keep really good records, clear books to prove you fall below those thresholds. You can't just claim it, you have to demonstrate it.
That makes sense. But doesn't a sharp cliff like 100 million turnover create a weird incentive? Like if I'm doing 105 million in revenue, won't I be tempted to, I don't know, find ways to make it look like 99 million to avoid tax altogether? Maybe split the business.
That's definitely a concern raised in the analysis we looked at. It's a known issue with sharp thresholds. The tax authorities, the FIRS, will likely be watching closely for any kind of artificial business structuring that looks like it's purely designed to stay under that limit.
So it puts pressure on enforcement to spot the difference between genuine small businesses and slightly larger ones trying to game the system.
Exactly. It's a trade-off. Great incentive, but requires robust monitoring.
And this brings us to that whole challenge of the informal sector. The market traders, the artisans, drivers, tailors, people who often don't have formal accounting. How does the Act plan to bring them into the net without being unfair?
Right. This is where the concept of presumptive taxation comes in. It's basically an acknowledgement by the law that, look, for some small businesses, detailed records just aren't realistic or available.
So they guess your income.
Not exactly guess. They estimate it. The tax authority is given the power to estimate your likely income based on certain reasonable factors if you can't provide reliable records yourself.
What kind of factors?
It could be things like the size of your shop or stall, the location, is it prime spot, how many people you employ, if any, the type of business you run. They'd look at averages for similar businesses in that area.
Let's take that tailor example you mentioned earlier. Say they earn maybe 1.5 million a year, roughly, but have no receipts kept for fabric, thread, machine repairs.
Okay, so a tax officer might come along, look at the size of the operation, the location, maybe chat with neighbors, and estimate that a tailor like that should be making, say, 1.5 million in revenue. Then they might apply an estimated profit margin. Maybe they assume 80% profit if there are no expense records.
So they'd assume euro 0.2 million profit.
Potentially, yes. And that 1.2 million profit figure would then be subject to the personal income tax rates we discussed earlier.
Okay, I see the danger there immediately. What if the tailor did make 1.5 million in revenue, but just spent 1 million on a huge order of expensive lace fabric for a wedding dress, which hasn't been paid for yet? Their actual profit might be much lower, but without proof.
That's precisely the risk. The law taxes profit, not just turnover or revenue. But the burden falls on you to prove your expenses. If your records are messy or non-existent, or if you mix your business cash with your personal money, the tax office might just look at the total money that came in and assume a high percentage of it was profit.
So the absolute key message here for even the smallest trader is separate accounts and keep some kind of record, even simple notes.
Absolutely non-negotiable. A separate, basic business account, keep receipts, even if it's just taking photos of them. A simple notebook tracking money in and money out. It doesn't have to be complex accounting, but it has to be something to counter a potentially unfavorable estimation.
And the enforcement tools are getting sharper to back this all up, the TIN linkage.
Yes. That mandatory link between your tax identification number and all your bank accounts is central. Banks have to verify TINs. And there's talk, some sources suggest that certain levels of account activity, maybe around 25 million turnover in a year flowing through accounts, could automatically trigger a closer look or flags for review.
It sounds a bit scary, like they can just dip into your account.
No, it's important to stress the due process. The tax authority can't just seize money arbitrarily based on an estimate. It's about transparency and asking questions.
So what's the process?
They have to issue a formal assessment notice explaining how they arrived at the figure. You, the taxpayer, must be notified. Then you have the right to object, provide your own records, appeal the assessment. Legal recovery actions can only begin after that process has played out. It's designed to prompt compliance and discussion if your lifestyle or account flows seem way out of line with what you've declared.
Okay, let's pivot now to Nigerians living outside the country, the diaspora. This is often a really complex area in tax law, and it sounds like this act makes some bold moves.
It does. It tackles the question of tax residency head-on using a very clear metric, the 183-day rule.
Ah, the magic number, 6 months.
Exactly. It's basically a test. The law looks at how much time you, as a Nigerian citizen, physically spend inside Nigeria during a tax year.
So break down that distinction for us, non-resident versus resident for tax purposes.
Okay. If you spend less than 183 days cumulatively, doesn't have to be consecutive inside Nigeria in a given year, you're generally considered a non-resident for tax purposes.
And what does that mean for tax liability?
It means Nigerian income tax applies only to income that comes from a Nigerian source. For example, rent you collect from a property you own in Abuja, or dividends from shares in a Nigerian company. Your salary earned working abroad, say in London or Houston, is generally not subject to Nigerian tax if you're non-resident.
What if I do cross that 183-day line? Maybe I work remotely for a foreign company but spend, say, 7 months back home visiting family.
Then you cross the threshold. If you spend 183 days or more inside Nigeria, cumulatively within the tax year, you are likely considered a resident for tax purposes under this act.
And if I'm a resident, even if my job is technically based abroad,
Then your global income potentially becomes subject to Nigerian income tax, according to the progressive rates we discussed.
wow, that's a significant change, especially with remote work being so common now.
It is, and it reflects a global trend, really. Many countries are reevaluating tax residency rules now that work isn't tied to a physical office in the same way.
Okay, the immediate question then is double taxation. If I'm deemed resident in Nigeria because I spent 190 days there,
Yep.
but I'm also paying income tax on my salary to, say, the UK's HMRC or the US IRS, surely I don't pay twice.
No, you shouldn't have to pay the full whack twice. This is where foreign tax credits come in. Nigeria, like most countries with residency-based taxation, will generally allow you to claim a credit for the income tax you've already paid to another country's government on that same income.
How does that work practically? Do I just tell them I paid tax abroad?
You need proof. You have to provide official documentation, tax receipts, assessment notices from the foreign tax authority like HMRC or IRS, clearly showing how much tax you paid, on what income, and for which period.
And if I can't provide that proof,
Or don't bother. Then the Nigerian tax authority, the FIRS, essentially assumes no foreign tax was paid, and you could be assessed for the full Nigerian tax liability on that global income based on the progressive schedule. The burden of proof is firmly on you, the taxpayer, to claim and document that foreign tax credit.
so keeping meticulous records is crucial not just for business expenses, but also for taxes paid abroad if you're near that 183-day mark.
Absolutely critical.
Okay, whether you're running a small business, working online, or living abroad, it sounds like everyone needs a clear action plan. What are the essential steps people should be taking, like, right now, even before 2026?
Yes, preparation is key. This needs to start now. First, get your tax identification number, your TIN if you don't have one. And crucially, make sure it's correctly linked to all your bank accounts. Check with your bank.
Okay, number one, TIN sorted and linked.
Second, if you have any kind of business or freelance activity, no matter how small, open a separate bank account for it immediately. Stop mixing personal and business funds.
Separate accounts. Got it.
Third, start keeping basic verifiable records of income and expenses. It doesn't have to be fancy. A simple spreadsheet, accounting software if you like, or even just a dedicated notebook and taking photos of receipts on your phone. Something is better than nothing.
Basic record keeping. Makes sense.
Fourth, if your business turnover is getting anywhere close to that Euro million threshold, make sure it's formally registered. You need that formal status to potentially claim the zero tax benefit.
Register if you're near the limit.
Right. And fifth, specifically for anyone earning digital income, track all those platform payments, the PayPal transfers, the ad revenue. And just as importantly, track your legitimate business costs, software subscriptions, data plans, maybe a portion of your internet bill, dedicated equipment you bought. These can potentially be deducted to lower your taxable profit.
Track digital income and costs. Good point. And just to circle back on something we touched on earlier, the fear factor. It's important to reiterate the due process, right? The FIRS can't just empty your account because they think you owe tax.
Absolutely. That needs to be clear. They must follow protocol. Issue a formal assessment notice. Notify you properly. Allow you time to respond, object, provide evidence, or appeal. Enforcement actions like freezing accounts or legal recovery only happen after that process if the liability is confirmed and unpaid.
Okay. Now, connecting all this back to the bigger picture, the sources we looked at highlighted some major public concerns or challenges around this whole reform, didn't they?
They did. Beyond the implementation details, there are a couple of big ones. First, inflation. That 800,000 tax-free threshold seems okay now, maybe? But if Nigeria's inflation continues at high rates...
That 800,000 could become meaningless quite quickly, worth much less in real terms.
Exactly. Some analysis suggests that threshold might need revising upwards fairly soon, maybe even by 2028, just to keep protecting the genuinely low-income earners it was designed for and avoid dragging people into tax brackets purely because of inflation, not real income growth.
And the other major issue, probably the biggest.
It's the trust deficit, the social contract issue. There's widespread frustration, as highlighted in the sources, because people feel they already pay a lot. Various levies, VAT, bank charges, tolls.
And they don't always see the benefits.
Precisely. There's a strong feeling of, why should we pay more tax? Or why should more people be brought into the net if we aren't seeing clear, tangible improvements in public services? You know, better schools, reliable hospitals, safer roads, and crucially improved security. That link between tax paid and services received feels broken for many.
So the government needs to demonstrate value for money, essentially.
That's the core of it. The success of this act isn't just about efficiently collecting more revenue. It hinges on the perception of fairness in enforcement, especially with things like presumptive tax, and on delivering visible improvements that make people feel their contributions are worthwhile. Without that, achieving widespread voluntary compliance will be tough.
It's clear the Nigeria Tax Act 2025 is a landmark piece of legislation. It's a serious attempt to modernize the system, bring clarity, structure, and ultimately more revenue for the state. If it works as intended and is implemented fairly, it really could reshape Nigeria's financial landscape.
It absolutely could. We've broken down the what and the how, what's taxed, how it's calculated, how to comply for residents, businesses, the diaspora. The rules are definitely aiming for more clarity, but maybe the final thought to leave with you, the listener, is this. Given that the rules are clearer now and the tax net is undeniably tightening, what tangible returns will you need to see? What improvements in daily life, better roads, functioning schools, feeling safer will the government need to deliver to truly earn the trust and willing compliance this ambitious reform depends on? That reciprocal social contract, that's the real long-term test here.